everyone. It's so good to see all of you. Welcome to the exclusive first look at Evergreen Wealth. Thank you for being here. Yeah, thank you. I'm Sarah Mogel, Director of Strategy at Evergreen Wealth, and it's truly a pleasure to be joined by all of you, both here in New York. So good to see all of you, and thank you to those of you tuning in from the live stream as well. Now, I must say, when I look at all of your gorgeous faces here in New York, I feel your pain. I feel your pain that all New Yorkers feel every year when it's April and you see your tax bill. Oof, that is a painful feeling. I lived here for 10 years and that tax bill was never fun to take a look at. But this isn't just a problem in New York. This is a problem across the country. Any high tax state, think California, think Connecticut, New Jersey, Washington, Oregon. Investors across the country are being let down. But luckily, Evergreen Wealth intends to fix that, because at Evergreen Wealth, we believe that it's not about what you earn, but it's about what you keep that truly counts. Now, after my 10 years in New York, I did what all New Yorkers eventually do, and I moved to Miami. But I moved to Miami for good reason. I moved to join a part of an incredible team that works really hard every day to build a solution for you to really solve this problem so that you all can build lasting wealth for you and for your families. And the solution that we built for this problem is really from the visionary Bill Harris. Bill's solution for this problem is really the culmination of his entire career, which has spanned technology, finance, and tax. Bill has been the CEO of Intuit, CEO of PayPal, founding CEO of Personal Capital, founding CEO of One Finance, and I can keep going, but he's founded 8 other financial technology and cybersecurity companies over the years. And now I'm proud to say that he's my boss and founding CEO of Evergreen Wealth. Today, you'll hear from Bill as he walks you through the solution so that you all can keep more of what you earn. And then he'll be joined by his dear friend, Michael Loeb, for a fireside chat. And finally, we'll conclude with a Q&A from all of you here in the room in New York and also from the live stream at home. Now, let's hear it from the visionary himself. It's my pleasure to introduce to you Bill Harris. Thank you.
Thank you, Sarah. Pleasure to be here. I'd like to tell you about what we do. We do 2 things, is investment management. And there, we try to give you a better risk-adjusted return and a higher after-tax performance, which at the end of the day, that's why you come to an advisor, to end up with more money. But the second thing we do, equally important, is financial advice. And there, I think we've got the Goldilocks formula of putting together man and machine, AI and the human guidance, human in the loop, that is appropriate and required if you're going to use AI for something as consequential as your long-term finances. So, on the dynamic portfolio side, on the investment management side, we do 2 things. First, on the investing, we use Nobel Prize-winning investment principles to deliver the optimal risk-adjusted return. That's pre-tax. But then, after tax, most financial institutions, they do not even think about taxes. Why? Because it's completely idiosyncratic and it's hard, it's complex. But in fact, if all you do is pre-tax results, you're not serving the customer. The only thing that they can put in their pocket is after-tax money. Flipping over to the financial advice side, once again, we do 2 different things. We provide advisors, dedicated wealth advisors, that work with each and every individual client. And we pair them with the technology, today's technology, an AI advice engine that's powered by our financial knowledge base and the individual financial information of each client. You put these 2 things together, and it's 1 + 1 = 3. Better investment management, better financial advice. That's why we built Evergreen Wealth. Now, let me take you back on a history journey. I'm going to go back 150 years. And no, I'm not that old. But over the course of that period, there have been 4 generations of investing methodology. Each one of those methodologies has been built on the back of a technological revolution that has enabled these changes in investment management to take place. So first, the brokerage account. This, to me, was the first and probably the most important innovation of all. And I tell that to people, and they say, what in the world could possibly be innovative about a brokerage account? Well, think about what came before. Before, you had to be on Wall Street in order to sign the papers with your attorney to take an equity position in a company. Now, all of a sudden, anywhere in the country, you could buy stocks just by walking down to your brokerage. What was the technology that enabled that? It was the telegraph. The telegraph and the ticker tape machine, built by Thomas Edison. And interestingly, if any of you are coders, do you know what the coding environment was for this technology? Morse code. DIT dash dash. Probably the first digital code. And it worked. It was sufficient. So then, what was next? What was next was the mutual fund. The first mutual fund was in 1924, but it didn't catch on. Almost nothing. Until the late 60s. How come? In the late 60s, the IBM 360. And by the way, I was in junior high at that point, and I actually got to use one on a time-sharing basis, and it was incredible. It was the first commercially successful computer. Because of that, because of the power of the IBM 360, all of a sudden, if you're running a mutual fund, all of a sudden you could calculate the daily price and distribute it across thousands or tens of thousands of clients before the next sunrise. Batch overnight, COBOL. But it was sufficient. And by the way, you develop your DNA. As a company, as a tech company, you develop your DNA very quickly. And in fact, today, mutual funds still are priced once a day, overnight batch. So what was next? The ETF. The ETF reformed the mutual fund. Higher diversification, lower cost, and real-time trading. And now, it was actually my personal hero, one of my personal heroes, Jack Bogle, who grabbed the investment industry by its hair and dragged it into the 21st century. The ETF is the better way to invest than a mutual fund and the better way to invest than a brokerage account. And today, after decades, it represents probably about half of the fund investments in the country. The ETF. What was the enabling technology? Pardon me? Actually, it was even before that. It was the Sun Spark servers that hit Wall Street. And all of a sudden, so many things could be done in real time. You remember before that, it was people just sitting on the floor with tickets. Now, all of a sudden, you had the compute power to do everything in real time. And by the way, ETFs, trading ETFs in real time, is even more complicated, requires more compute than just buying and selling stocks. So it was the Sun server, once again, a revolution in technology that allowed a revolution in investing. So where are we now? We're today announcing the dynamic portfolio. And what is it? It's a tax-optimized, personalized, diversified way to manage your money. And of course, what is the enabling technology? It's raw compute power. It's the chips today that can do so much more than they could do when I started my last investment advisor, Personal Capital. We did some of the same things for some of the same customers. But we didn't have this kind of computing capability. And so much of it was either manual or slow and imprecise. Now, Sure, you've got the NVIDIA Blackwell chips, but you also have just regular chips that have so much capacity, so many CPUs packed into one, that we can do an incredible amount of compute, which allows us to do things in a completely personalized way for each and every customer. Dynamic portfolio, what do you get? You get professional construction, extreme personalization, synchronization across your entire portfolio, daily monitoring, and of course, tax optimization. How do we do it? Let's talk about the pre-tax side first, investing. And by the way, if you go to any fund and most advisors, the only thing that they will talk to you about is pre-tax returns. Why? Because taxes are completely idiosyncratic. They are varied for each individual, and they're complex. So nobody knows how to do it. Nobody has the technology to really dive into taxes. So, Nobel Prize winning investment principles. This is all on the pre-tax side. What do we learn from the Nobel laureates? First and foremost is Harry Markowitz, the father of modern portfolio theory. He was actually the very first quant. He actually was not an investing professional. He was a coder. He developed his own coding language to do linear programming a long, long time ago. And he took that quantitative analysis and he brought it to investing in a way that had not been done before. It was all hunches and tips until Harry came along. And I think he is the pinnacle of modern investing. I was lucky enough to work with him a decade ago for a number of years. He advised me on my previous company. And the fascinating thing was, at that time, even at his age, he was in his 80s at that point. At that time, he was doing brand new research in tax optimization. Now, I didn't participate in his research, but he advised our company, and at that very time, we were building some of the very first primitive ways to do tax loss harvesting. There was more than just selling a couple of things on an Excel spreadsheet in December. And so, Harry Markowitz, we're trying to carry on his tradition, not only his, but there are 6 Nobel laureates: Harry Markowitz, Bill Sharp, Eugene Fama, Daniel Kahneman, Albert Einstein, and Richard Thaler, who have defined the way to invest in a modern era. Albert Einstein. Well, I'm fibbing a little bit. He got his Nobel in physics, not in economics. However, he knew math. And he is said to have said, compound interest is the 8th wonder of the world. And he was right. He was right. Occam's razor. He zeroed into the heart of the issue. Because if you're trying to build lasting wealth, the key, even more important than pre-tax return, even more important than after-tax return, is to invest. To invest early and often. And that's what we can learn from Albert Einstein. Because I never learned about relativity, so at least I can do this. Richard Thaler. Richard Thaler was the co-parent, along with Daniel Kahneman, of behavioral finance. What is behavioral finance? It is the study of what they call cognitive biases. These are the things that are instinctual and result in making poor decisions, particularly in the investment arena, because it's when you put emotion ahead of rationality. One of the important ones is risk aversion, herd mentality, recency bias. And let's listen to Richard Thaler, along with Selena Gomez, just to make it a little interesting. Let's listen to them describe the hot hands fallacy.
Let's say I bet 10 million on a blackjack hand. Okay, Selena has a pretty good hand here, showing 18, dealer showing 7. That's a really good hand for Selena.
So, my odds are good. I'm on a winning streak. How could I lose, right?
Now, this is a classic error. In basketball, it's called the hot hand fallacy. A player makes a bunch of shots in a row. People are sure they're going to make the next one. People think whatever's happening now is going to continue to happen into the future.
Herd mentality. When markets are hot, we get greedy. When markets are cold, we get fearful. So we buy at the top and sell at the bottom. We kill ourselves. We kill the return. And so one of the things we're doing at Evergreen is making sure that we have a disciplined program in place that is consistent year after year through all the market cycles so that you don't fall prey to the hot hands fallacy and many other cognitive biases. It's proven. This is a study from a long-running study from a research group called Dalbar. And what they did was look at the actual performance of investors in funds, ETFs and mutual funds, and compared it to the performance of the funds themselves. And the investors in the funds did worse than the funds. How is that? Well, they're buying at the top and they're selling at the bottom. And this is one of the ways we can help people, by getting them over that kind of cognitive bias. Now, if you're an investor, like every investor, you're worried about two things. A dual objective. You want to maximize return while minimizing risk. Because investing means taking risk. If you don't want to take any risk, put your money in T-bills. You won't make a whole lot of money, but you'll be safe. If you want to get higher returns, you have to take more risk. You can take a little, you can take a lot. You can go into corporate bonds, you can go to international stocks. But you have to accept risk. And so what is the dual objective? Maximize your return, minimize risk. What's the metric? The metric is risk-adjusted return. And so on the investment, on the pre-tax side, that's what we're doing. We're trying to help you deliver optimal risk-adjusted return. So then we go to taxes. We have 12 advanced tax strategies, including direct indexing. Why is it important? Sarah and I have already talked about it. If you are a single taxpayer in New York City and make $275,000 a year, what is your tax rate? 50%, as high as 50% on interest. This means your corporate bonds, this means your bank account. You know, if you're at any of the big banks, you're making nothing anyway. But if you are at a high yield savings account, you're making 4%. You feel pretty good. Don't forget taxes. You're making 2%. And that's not even keeping up with inflation. How do you build long-term wealth like that? So, interest is 50%, capital gains and dividends, a little better, 30%. But if you do direct indexing tax loss harvesting, you can bring the tax rate on capital gains down to 0. With deferral, tax loss harvesting, to 0 today. And then you can also, in some instances, eliminate the taxes altogether in a couple of ways that I'll talk about later. It's not what you earn, it's what you keep. 12 tax strategies. The first couple we've been talking about, direct indexing and then tax loss harvesting. Now, there are a couple of intrepid firms out there, like ours, that are doing for the general population tax loss harvesting, direct indexing. But they're typically doing it on an account basis. We do it across the entire portfolio. What you end up with is higher after-tax performance than a comparable equity ETF or mutual fund. At the end of the day, that's what counts. Direct indexing, it's everything you would get in an ETF, plus personalization, plus tax reduction. How does it work? We take an ETF and we deconstruct it into its component securities. So it's not the S&P, it's not the single security that tracks the S&P 500. You end up with hundreds of stocks, individual stocks, within the S&P 500. What does that allow us to do? The first thing it allows us to do is personalize. And so, because we have control of each of these individual securities, we can sculpt a portfolio specifically designed for your needs, your investment preferences, any concentrated positions, held away accounts. We build something that is absolutely unique for you. That's number one, is the personalization. And then we monitor. We monitor every single day. We monitor every tax lot of every security, of every client, every day. We couldn't do that without the kind of technology that's now available. We are making 100,000 buy-sell decisions every year for each client. Now, we don't trade very frequently, but we're always monitoring. And what is one of the most important things we do? We take the losses and we harvest them, because we are building up a reservoir of tax benefit for use today and in the future. What is the benefit of all this? Tax loss harvesting alone can get you, if you are a moderately high income individual, can get you an additional 29% in after-tax return after 10 years. Far in excess of anything you might do if you happen to be lucky enough to find a guru who actually can beat the market. And by the way, I don't believe that they exist. Not on a statistically reliable basis over the long haul. So 29%, that's the starting point. That's just with strategies 1 and 2. But we have 12 strategies that, depending upon the situation of each individual, we will employ. And let me talk about 4 of them. The first is the enabler, not tax loss harvesting, which can defer gains, but tax gain harvesting, where you can actually eliminate them. How do? You take the gains, you don't sell them, you transfer them out of your account and use them for family gifting, use them for charitable giving, use them for inheritance purposes, stepped up basis at estate. And so what you end up with is the ability over time to completely eliminate taxes on some of your investments. At the end of the day, what do I say? Follow these strategies and you can offset, reduce, defer, or in some cases even eliminate tax on your investments. So now I'm going to flip to financial advice. First, the advisors, personal wealth advisors, dedicated advisors assigned to each individual client. Let's hear Matt. Come on, Matt.
I'm Matt, an advisor at Evergreen Wealth. Like some of you, I've got a family and I know what it's like to balance today's needs with tomorrow's goals. I'm thinking about retirement, but also about my kids' education and everything in between. I've dedicated my career to helping people realize their dreams for themselves and their families, and I'm here to help you do the same.
Now, let me tell you, you cannot get that from a robo-advisor. You also can't get it in the same way from a regular advisor, because we combine it with the technology. But it's the human that provides the understanding and the empathy. And we're humans. We still deal with things that are emotional person to person. And make no mistake, some people think that money, because it's quantitative, is analytical. It is not. It is the most emotional topic that you can think of. It's, more people get divorced because of money than because of love and sex. In order to deal with those kinds of emotional and personal things, having a dedicated advisor always ready for you is an incredible thing that helps you sleep at night. So, who are our clients? Our ideal clients? They're achievers in their peak working years. And they're building their careers, they're building their families, and they're building their future. And in order to build that future, They need this kind of help, this kind of advice, this kind of discipline in order to build what they will need for their family now and for decades to come. What do we do? What do the advisors do for our clients? They understand them. They suss out what the needs and the requirements are, and then each one designs the portfolio, the hyper-personalized portfolio for that individual client. And finally, it comes to financial decisions. And here again, you need not only the technology, not only the information, but also someone who can work with you on a person-to-person basis in order to make those few consequential financial decisions that you will make, and by the way, to help you stick to the plan against the emotion, against the human tendency just to think of the present, not of the future. We give advice the way you want it. Many advisors, they've got a program. It's a 5-step program. It's a 7-step program. You come to them and they will fit you into that program. And it's quarterly meetings and it's doing things on their schedule. We meet our clients where they are. We meet them with whatever questions they have whenever they want. You can get the information in our app, or you can get it through the advisors, however you want, whenever you want. And finally, we're all about education. We're all about improving the understanding of your money. Americans, they live unexamined financial lives. We want to change that. Money is too important. People close their eyes, they're interested in other things. We want to help them understand, because it's with understanding that you can make change. Finally, let me get to the technology side of financial advice. We've developed an AI advice engine specifically tuned to the financial arena. We take a financial knowledge base, a vetted financial knowledge base that we have created, combine it with your personal information, and then put over top an AI-based advice engine. We call it Evergreen Intelligence, the financial knowledge base plus the information on your own financial situation. What is it? First of all, an investment knowledge base, real-time prices, historical data, fees and expenses for all stocks, ETFs, and mutual funds, including on the mutual funds, the constituents of every single mutual fund, so that we know when we're trying to help you analyze your current portfolio, we can tell you exactly what you actually own under the hood. That's the investment knowledge base, then a tax knowledge base. And we've taken every IRS publication and all of the recent bulletins, and we've assembled and synthesized and organized and made accessible all of that tax information to you right in the app. And it's also, of course, available to the advisors. Broad, deep information on taxes available at your fingertips. Finally, a financial knowledge base. And this we have built ourselves. This is our own vetted financial knowledge base to answer the kinds of questions that you all will have. Your personal information, the most important part, because you could go to GPT, you could go to Claude, you could go to Perplexity, and you could ask them, okay, tell me about a Roth conversion. And it'll give you an answer, and probably a very good answer, and deep and broad and fast. But all it is information. If once it's combined with your own personal data, your own personal situation, all of a sudden you're taking in information and putting it in context, turning it into actual advice based on what you need to know. And with this private data vault, why can't you do that out on the internet? Who here is going to put their private financial information out on the internet to GPT? I don't know anyone. So we end up being the guardians of your data. and we keep it in a private vault. It's safe from hackers. It's safe from the internet. It's even safe from the models themselves. It is not used to train the models. We become the guardians of your data, and that way we can make AI so much more valuable to you. And of course, finally, the AI engine itself, tuned to this particular arena and equipped with the knowledge on the one hand and an understanding of you on the other. So, what does that look like? Let's take a look at the app very quickly. We take the three components of what we do and put them all together into the home screen in the app. First, your accounts. And what is this? This is nothing special. It's just transactions and holdings and balances and all of that, everything you would typically see in a personal finance manager, in any financial app. But it's even better because in a financial app, and I've built 3 of them, in a financial app, sure, you've got that information, but then you have some analyses, and you've got a page that will do a donut with a sector allocation and another page that does something else. And when you want to know something, first of all, you have to find it in the app. And then secondly, once you do find it, it's not really what you were asking in the first place. But by using the AI, we can answer not the question that we have built a page for, but the question that you have on your mind right now. What was the sector allocation of my internal and external accounts on March 4th, 2023? Boom. There it is. Number 2, financial insights. And this is where we inform you. We look at what's going on in your accounts, what's going on in the market, what's going on with the kind of investment principles that we advocate, and we are showing you what we think you need or should know right now. This is us talking to you. And then finally, Evergreen Intelligence. This is where you ask us. And that little question box, that appears on the bottom of every page in the app. So no matter where you are, if a question comes up, we're there for you. The answer is available and immediate. So I'm going to sum it all up. What do we do? 2 things. Investment management and, I'm pointing the wrong way. Investment management and financial advice. In each of those, we do 2 things. We do the pre-tax and the after-tax, so that at the end of the day, you've got the best risk-adjusted return and the best after-tax return that we can make for you. Again, what's the point? More money in your pocket. On the financial side, go back. On the financial advice side, again, the combination of 2 things, advisor and technology, the human and the machine. And that is 1 + 1 = 3. Human in the loop, human-guided AI, specifically tuned for the financial arena. So what we do is complex, but our mission is simple: to build lasting wealth for you and your family. Thank you.
Thank you, Bill. Okay, fantastic. Well, Bill will be back with us in a second. We're going to get set up for a fireside chat, and we'll be back in just a minute. Thank you. It is time for our fireside chat. Is everyone excited? Yes. Thank you. I heard that. Thank you very much. Okay. We're joined by a very special guest today that it is my absolute pleasure to introduce. Michael Loeb. Michael Loeb, President and CEO of Loeb NYC. He has been Bill's friend, dear friend, for how many years now? 39. Michael Loeb, 39 years old. We're so happy to have you here. I would love to welcome you up on stage. Michael Loeb. And Bill Harris, welcome back. Okay.
Okay, Michael, you have to sit under your own name over here.
I got to, okay.
Yeah, because that's you.
Thank you for that. Thank you for that. I never want it to be me, so it's to be better. Thank you, Bill. So you said good friend for 39 years. I think it was maybe 9 of those years we were good friends.
Ah,
Through those
yeah. The rest of the time we were
Frenemies.
competitors, frenemies.
frenemies, yeah,
Yeah.
frenemies. We both cut our teeth in, God bless its soul, Time Inc., which at the time was the greatest publisher of magazines by far in the world.
By far.
By far. And
With the best people.
with the smartest
Yes.
and best looking.
Well, some of them.
You know, it's amazing to encounter a guy like Bill because he is irrepressible. The fact that he is still at it at his great age is
Going
really pretty
going
amazing.
on, if you round up, I'm 100 years old.
Yeah. So, and you know, you did it once before, built a unicorn, and you're fond of saying that this is the 15-year advance of what you had. And that was pretty successful. So we have great expectations. Everybody in this room, we have great expectations. I think everybody is getting 100 shares of free stock.
Well, yes,
Is that right?
yes, but everybody in this room becomes a client before we let you out the door.
We have some very large men out there, big biceps, right? They're very aggressive. But yes, it happens to be true. You got to be a client before you leave here. Big advance from the last one is AI, right? And
Yes.
all the data and all the analytics and machine learning, everything you can apply to that. And I think you kind of gave us an idea of what Evergreen Wealth is going to have, but why don't you contrast it a little bit to the last one? What are some of the really big advances?
I mean, I'll go back to what I said before. The first one is just the precision, the incredible precision with which we can automate not only your investment landscape, but the entire financial landscape. We did a very pale version of this at Personal Capital. And we were doing some of the first tax loss harvesting. Personal Capital, it was 2010. And at 2010, we launched at just about exactly the same time as the first of the Robo-Advisors, Wealthfront and Betterment. And I went around, we were all digital investment outfits, but I went around the countries saying, don't call me a robo, because we weren't. First of all, our clients had 10 or 15x the account size. Second, our software was significantly more robust. Third, we put you in individual securities, whereas even today, most of the robos put you in just ETFs. And then finally, and most importantly, we not only had algorithms, we had people. So all of that was a presage for what we're doing today. However, 15 years ago, and 15 years is a lifetime, is a couple of lifetimes in technology. And so it's now doing it again with the kind of technology that we have is just brilliant. And I think we're coming at exactly the right time because there's just enough flourishing of AI that we know how to use it, we know how to train it, we know how to control it. We have models that are generating the answers. First of all, we have models that are interpreting the questions. That goes to models that are generating the answers. That goes to models that check the accuracy of the answers for hallucinations. And then that goes to models that checks the compliance. That kind of thing wasn't possible 6 months ago. And so we're very lucky to come to the market right now.
One of the points you make, this is really the merger of the human and the technology and the AI. And you made the point that AI could not do some of this, right? We're taking a look at humans. Don't you think we're going to come to a place at some point in the future, maybe near future, that's no longer the case, that the AI can totally replace the human being, that we're so good at synthetic imagery that you can't make the distinction?
I think that's right. I think it'll happen. I don't think it'll happen quickly. I mean, if you go back, I was going to say if you go back 2 years, if you go back 20 years, if you go back 50 years, people have been talking about how this is going to be possible right around the corner. And yes, incredible progress is being made in the past 2 years, in the past 1 year, in the past 2 months. But still, we're not to the point where we have the judgment and the ability to interact with people that we will. Now, what kind of time frame would I put on it? Somewhere between 5 and 10 years. And when that happens, we hope to be the leaders in the pack, developing first the integration of man and machine, and ultimately going even farther. But it will be at least 5 or 10 years before before AI can replicate in this environment what humans can do.
So this is a very crowded space. When I say this, just financial advice, right? There's millions of incumbents, some of them very, very muscular, very large, huge buckets of money that they can deploy any way that they want. What makes you think, Bill? What level of arrogance do you have? Do you think that you can supplant the Goldman Sachses and the Morgan Stanleys and God knows who else is out here with their armies of wealth managers with this tool?
Thanks. Great question. I have no answer. No, first, let's take it piece by piece. First of all, the arrogance. Yes.
Guilty
and in fact,
as charged.
Guilty as charged.
Yeah.
And I'll take you back to not 15 years ago, but 25 years ago. 25 years ago. I was the founding CEO of PayPal, along with Elon Musk, Peter Thiel, et cetera. And we used to, Peter Thiel, Elon Musk, Max Levchin, and myself. None of us have an ego that would fit in a large gymnasium. Theirs are a little bigger than mine, but still. But here's why. I mean, it's not only the belief, which you have to have as an entrepreneur, that you can go do things that maybe a rational person wouldn't attempt. But here's why I think we can succeed. Because we're doing something new. And the established players, they win on the straightaways because they've got bigger engines. But the minute you get into the curves, then it's the person who's agile, the person who can turn and weave, that wins. And we did it at Personal Capital. They were the same huge competitors 15 years ago. And we invented a new form of advice called the hybrid advisor. And it's only 10 and 15 years later that many of the largest organizations in the country are attempting to do the same thing. The one other thing I'd say, and I'm going to try to remember it right now. Yes. So we were there, we were sitting around with like 40, 50 people. And they had 40, 50,000 people. And we were spending who knows what, $1 million or $2 million a month. They're spending, even in those days, billions of dollars, multiple billions of dollars per organization per year just on tech. They own half of India. But they can't move. And the same thing is true today. Plus, what are they motivated to do? If you're running Chase, you're investing a lot of money in AI, but what are you doing with it? You're looking at a 300-person call center, and you're saying, if I did that with 30 people, imagine what I could save. They're putting it into cost reduction. We're putting it into service enhancement. And that's one of the reasons that I think we'll just motor, like the little mice around the dinosaurs, until we get to a reasonable volume.
So one of the things that occurred to me, and I think you'll concur because I said it first, but is that even if...
May I just concur in advance?
Yeah. That even if we had all the tools of AI, and even if it was so good that we couldn't make that differentiation, I think people still want a human being somewhere in the mix.
Yes.
Knowing that a human being. Can you comment on that a little bit? And what did you see in Personal Capital that made you...
Well, in Personal Capital, look, let's compare it to the Robos. The Robos, they got a lot of customers very quickly. They now have millions of customers because it was easy to sign up, it was cheap, why not give it a try? And particularly younger folk who don't have complex finances, don't have an amount of money that is really important to invest well, and are not even thinking about the long term. Fine, it's an easy thing to go do, but what they end up with is a lot of small accounts. And for us, we were providing not only a much more robust service, but most importantly, the individual advisors that you can establish a personal relationship with. And that, at the end of the day, was the crucial thing. We had $1 million accounts. They had $50,000 accounts. We had $1 million accounts and higher. And if you've got $1 million, even today, you're not going to go put that into some young tech firm without the experience and the trust building of working with with a real person.
Well, I'm glad to know that we're not obsolete already.
Well, I didn't talk about you.
Okay. I put that in the bucket. If you had to paint a picture of the future, 2 years from now, 5 years from now, what does your company look like, and what does the state of wealth management look like?
Unfortunately, I think the state of wealth management will still be lagging because it's lagging now. It's a backwater. There's just not much technology. If you look at the biggest and one would argue in some ways the best of the consumer-facing financial advisors, which is Fisher Investments. Fisher Investments does not have, I don't think, the kind of investment quality that we have, has absolutely no technology. They do not even have an app. If you're an advisor, you go to Schwab to understand what you've got. And they are the largest, in many ways, the most productive of the financial advisors of the RIAs. But that's the state of the industry, particularly in terms of technology. And so what do I anticipate 5 and 10 years from now? We will have a significant amount of investor assets. At Personal Capital, we went from 0 to 23 billion, and that made us the 9th largest RIA, consumer-facing RIA in the country. And that was great. But the big guys, and there are 3 big guys, Vanguard, Schwab, and Fidelity. The big guys don't have billions. They have trillions.
Yeah.
That's where the money is. That's where the clients are. That's where we're going to find our clients. And so, no matter how big we get, we will be a speck in relation to those guys, which is good because that means we can pick off the people who are really looking for a technologically advanced solution. But here's what I hope. It's not so much about volume. It's about influence. And just as Personal Capital defined a new way to do financial advice, I hope we do that too. And I think we can with the combination of tax and financial advice, technology-driven, human-delivered advice. I think we have the opportunity to define what 5 to 10 years from now won't be prevalent in the industry, but will be generally recognized as the best way to do it, just as ETFs are recognized today.
So what do you imagine your legacy to be apropos to this company? What are you trying to accomplish?
Well, they only start talking about legacy when you get really old.
Check that box.
Yeah. Yeah. I'll speak arrogantly for a moment. It comes naturally. I've got enough money.
Right.
Why in the world do I keep doing this? Partly, it's to help people. I mean, I really believe in our mission. I believe that this is for responsible, forward-thinking families. This is the most important long-term thing. If you, at 65, you still have to provide for yourself and your family for another 25 years. How do you do that without starting early and building it up and getting ready? So that's number one. I think what we're doing is important. And then secondly, as do you, I just love ideas. I love new ideas. I love trying to see if they're real.
Now, are you getting some outside capital to help you with this, or is this like a Bill mission here?
So I thought you were going to say, are you getting some outside counseling?
Yeah.
And that's what I look to you for.
Right.
But
Have enough time actually for that.
yeah, no, it's a deep project. No, I'm self-funding, And I have not done that in the past. I've always had VC partners, and there's a tremendous advantage to having VC partners because they've seen it all, and they can help you, from falling into your own delusions. But
We're
in
way
this case,
beyond that.
yes, in this case, I decided to bask in my delusions. But here's the thing. So first of all, it's an incredible luxury to be able to self-fund at this stage, and it saves a lot of time. You typically end up spending about a third of your time trying to raise money as opposed to building the business. So it's huge in that way. The other thing is, if you have investors, even if you control on the board and the shares, every time you make a change, you at least have to call the board members and explain to them. And in this case, you have to explain to them not only what you're going to do, but also why what you said last month was stupid. And they can only take so much of that.
Board members with amnesia is really what you think.
Yeah. No, actually, I'll tell you what makes a great early stage board member. At many stages, the board members are supposed to keep an eye on management and keep them, what is better or worse on the monthly projections. No, the thing you need early stage, as you know, because you're on many boards, many early stage boards. In fact, you create early stage companies. What you need is a cheerleader. Because when you're starting something like that, every day you wake up full of enthusiasm, and by the end of the day, it's hopeless. How in the hell are we going to get this done? And you need to get up the next day with the same fire. And I tell you what, if your board is pissing on you, it doesn't work.
Yeah. So I just will point out a couple of things that you said. Observation number one, you're doing this to help people, right? And what's doubly noble about that is you're doing it with your own money. So if anybody were to question this man's motivation and what he is trying to do, okay, his conviction about what he wants to do for the world and his conviction about this idea and this approach, I mean, this is a double conviction. Not only that is your mission to help people, but also you're doing it with your own money. So that's incredibly noble and incredibly brave, and that describes incredible conviction.
Actually, I snuck into your house. I'm doing it with your money.
That's another thing you can do with AI, is that you can break into any safe.
That's
So
right.
That's always very helpful. But so what, Bill, is keeping you up at night these days?
Well, you know what it is? It's customer acquisition.
Yeah.
It's always customer acquisition. It's two things. You have to build a great product. I mean, in tech, you have to build a great product. And that's hard. And you have to get the right people. And it takes twice as much money and twice as much time. But you can do it. It is a defined job. Customer acquisition, you're rolling the dice. I mean, you just get out there and you test. And you hope something clicks. And this is the make or break moment for us, and the make or break moment for most consumer tech companies.
Got it. So, any ideas of how you're going to acquire customers? How?
Not a goddamn
Damn
one.
idea.
What I'm thinking
Spoken like a true entrepreneur.
Yeah. No, what I'm thinking of doing is finding as many people as I can, locking them in a room, and showing them so many big pictures
Like this.
Yeah.
Right? Yeah.
that they end up giving us their money to husband.
Right. And spiking the coffee. Who here had coffee this morning? Spiking the coffee always helps.
I think right now we might have some
Q&A?
Q&A, some questions either from the audience or from the live stream.
Over there.
Anybody have
David.
anyone have a more polite question than his? Yes.
Two questions. Are you covered by the FDIC? And do you have any conflicts?
So covered by the SEC, the FDIC, yes. And in fact, we are an alphabet soup of regulation. We are We do banking as well as investing. On the banking side, the deposits are insured by the FDIC. We are regulated by the Federal Reserve, by state regulators, and it's a very strict routine. On the investment side, we are registered with the SEC. They come in and do audits, and we are insured by the accounts are insured by the SIPC. So I'm sure there are some vowels that we left out, but not many. What was the other question? Any competition? Yes, exactly. There's no one like us. That's what my mother always told me. Yes, huge competition, just like you said, but different. So you've got the Robo-Advisors, and they're beautiful in what they do, but it's not what we do. And in fact, I really respect the Robo-Advisors, and I grew up right beside them. And why do I respect them? Let's take the alternative. The alternative is something like Robinhood. Robinhood is teaching an entire generation how not to invest. And it's a sin. The Robo-Advisors, they believe in diversification. They believe in the long term, exactly what we believe in, and so I really respect them. Now you look at the gorillas, the three gorillas. Each of them came from a different place. Schwab came from online trading. Fidelity came from mutual funds. Vanguard came from index funds. And they remain the best in each of their swim lanes. But none of them do a good job at financial advice. They do a good job at creating financial products, but they don't do a good job. They don't even try in financial advice. And then finally, there are the other advisors, some of them very good, but they operate in old ways, without technology and without immediate access.
David Rhodes had a question.
Two questions. One, given your innovation of effectively deconstructing ETFs and taking it down to the individual accounts and the individual positions, mirroring the ETFs on a very granular basis, how do you see long-term blockchain playing into this? Because that looks clearly like where it goes on a very granular basis, no?
Yeah, for what we do, blockchain doesn't come in for a while. Ultimately, and this is not going to be soon, but ultimately, I think what you do is you take this personalized portfolio and tokenize it.
And so then the next question is, right now, are the portfolios 100% in public equities, or are there other alternatives or any other kind of things that you're including in the portfolios at this point?
Yeah, so it's stocks, ETFs, mutual funds. Through the ETFs and mutual funds, it's bonds. We have cash equivalents. We do individual T-bills and other treasury bonds. But we don't do alts right now. And let me tell you why. The reason to do alts is diversification, because there is not perfect correlation. However, I'm not a fan, because let's just talk about hedge funds, PE funds, VC funds. First of all, your money is tied up for a long time. And that's fine for somebody who can afford to tie it up like Michael, but most people can't. Second, there's no price discovery. They don't mark to market. You have no idea how you're doing. And not only is that a problem, but it's also very difficult to actually show that these are not correlated assets and what the advantage for diversification is. And then finally, I'm allergic to things with that kind of a fee attached. It's typically 2 and 20 for VCs, hedge funds, PE funds, typically 2 and 20, which means you're paying a 2% fee right off the top, and then you're giving another 20% of the upside to them, and particularly for hedge funds that all they do is buy and sell public securities, it's just not worth it. The final thing I'll say is that PE as an example, but also some of the other alternatives that I just talked about, they really got their start on the institutional side. And still, it's 90+% of the activity. And if you really trace it back 30 and 40 years, it was David Swensen at Yale that changed the endowment model. and said, I'm no longer just going to buy public stock. I'm going to go out and do these other things. And he was incredibly successful. But in those days, there was nobody else doing it. And so he had the pick of the litter. And today, it's overcompeted, I would say. And particularly if you look in the PE arena, they're still living off of their track record from decades ago, but the returns are not good today.
That is correct. We're not good today. Other questions?
Thank you. And you are a very handsome gentleman.
And much younger.
No, you're not.
My question is, how do you overcome the bias of people when it comes to their money wanting to be with the big institutions? You talk about Vanguard. I mean, everybody's inclination, right? My money is safer at a Vanguard. My money is safer at State Street. My money is safer at Fidelity. As a small shop, how do you overcome?
Not for long.
How do you think about that when it comes to customer acquisition?
Yeah. So the most important thing, the most difficult thing is establishing, just as you say, trust. A brand new organization that you've never heard of, that operates on the internet and wants $1 million of your money, hard one. And so you have to build a reputation. How do we build a reputation? You do it like Google did. There are two ways to build a reputation. One is advertising, and the other is experience. And we don't have the money to do advertising. I mean, we do a little bit, but in order to get known, unaided awareness, we would have to spend hundreds of millions of dollars for multiple years. Obviously, we can't do that. So how do we do it? We do it by experience. We get somebody in, just like Google. How did Google go, right? The first time you ever heard of Google, oh my, it's this little thing on the web, and it'll answer any question you've got. Come on. But you try it once. Oh, look at that. Look what I got. Try it a second time. And now by the time you've tried it 5 times, you're hooked. And we attempt to do the same thing using the AI. We make a demo app public. We just launched it today so that anybody can come just try it out. And you know what I'll tell you, and you can't try it out on your own information until you become a client, but we've got a dummy client. He's not actually dumb, but he's just a dummy client. And so pretend you're, who is it, Michael Thompson? To pretend you're Michael Thompson and run your money. And if you like it once, try it again, you'll like it a second time, and pretty soon you say, wow, is this a better way to manage my money? Final thing I'll say is this. Yes, those firms have a great reputation and have a lot of trust. But there's a lot of desire for something more. There's a lot of desire for something more than buying the contra fund from Fidelity. And so we can play on that desire and deliver something that's different. All we need to do, this is what any entrepreneur who's doing something that is truly different, all we want is somebody to give us a try. So please, Michael.
Hey, Bill, we've got a couple of questions from the live stream.
Yes.
If you don't mind.
This is God up there speaking to us from the heavens.
Hilarious. For a prospective client, what would working with Evergreen feel like compared to a traditional firm?
You would feel like you're part of what's going on. And not just because we're a small firm and we really take an individual personalized interest in every one of our clients, but also because it is an immersive experience. Between the app and the people, it's not just I put my money with Vanguard and I've got a product. And by the way, the product with Vanguard, as much as I love Vanguard and love ETFs, still, it's a product. It's mass production. It's like Henry Ford. You can have any color you want as long as it's black. What we're doing is mass customization. That's what always comes, you start with a craftsman model, then you go to mass production, then you go to mass customization. And that's what the technology today allows us to do, not only to customize the investments, but also to customize the experience.
I would take issue with that because I don't think it's mass customization. I really think it's individual customization. Maybe it's individual customization at mass or at
Individual customization at scale.
Scale.
Yeah. Thank
That's
you.
my
I
understanding.
think you just wrote our next ad.
My bill
Another
is in the
question,
mail.
Bill.
Yeah.
We have, what is the minimum earning requirement to become a customer?
The funding requirement?
Earning, probably.
requirement to become-
In other words, this is, what is the threshold, right?
Yeah,
I think they're
so
talking about
in terms of
accredited
income.
investor.
Oh, no, you don't need to be an accredited investor, not at all. An accredited investor is somebody who has enough money that the SEC just assumes that you know what you're doing and lets you invest in silly things that you probably shouldn't invest in. But you don't need to be an accredited investor to invest with us. And you also don't need any income or anything like that. It's just, we do have a $250,000 minimum because what we're doing, particularly on the human side, we can't afford to do that. We can't afford to give this kind of service on millions of tiny little accounts. Wish we could, but economically it doesn't play. But what we're really looking for is, again, the ideal client has got a net worth of, between $1 and $10 million, has investable assets between $500,000 and $5 million, and for anybody in that range, we can deliver a level of service and investment sophistication that otherwise would only be available to people with $20, $50, $100 million. And not even then, because what that gets you is a bunch of high-priced tax attorneys with Excel spreadsheets.
So I do have a question. I have many questions, but one is, one of the things you talked about was somebody's risk profile. Now, we all know that when you get a little older, you need a bit more liquidity, your time horizon shrinks. But other than that, to me, there was some visceral thing that you were going after, like somebody's ability to take a loss and integrate it into kind of a long-term gain and feel okay about it.
That's where the human comes in. You know, if you go to almost any advisor, what they're going to do, they've got a formula. And it's based on a number of things, but predominantly your age. And so if you're young... We hate that, yes.
We hate that.
And if you're young, get 100% stocks. And as you get older, take it down to ultimately you're going to be 50-50 and then sometimes even less. You're all in bonds. Why? You need the money. In fact, it's even codified to the point that one of the big things today is called a target date fund. You are in one fund and you go in, let's say you're 40 years old and you start putting it in, and that would be the... what year would you retire? You were 25 years, so it would be the 2045 fund. You would put target date 2045 fund. It starts you out at 80% and then moves you to 70, 60, 50, 40. Predefined. Everybody gets exactly the same thing, and that doesn't make any sense. And so where do we, yes, we have formulas, and they're relatively sophisticated formulas to put you into a certain band, but where do we really, really operate? Once again, it's the level of the advisor, because it's only with the judgment and interaction of an advisor that you can really start to get a sense of what this person is going to be comfortable with. And then we try and save people from themselves. We talked about the hot hands fallacy, and we talked about trying to get people to be consistent and not pull their money in and put their money out. And that means, among other things, having a consistent risk profile. We break that. I mean, that's great investment theory, but we'll break it on occasion. Because if somebody really gets worried in a bad market, rather than pounding on the table saying, you cannot do anything, you have to keep all of your money in, we'll move the risk dial a little bit. We'll give you the emotional support of thinking, okay, yes, we're taking it down a little bit, but we're only taking it down a little bit, and we're preventing somebody from panicking and moving it all out. Once again, that's something only an advisor can do.
Another question, Bill, from up here from the live stream. How impactful is Evergreen's AI for the individual client versus helping advisors? Can you share an example of AI's impact for an individual client?
Sure. I'll go back to the Roth conversion. There are a lot of rules around a Roth conversion. Who can take it, who can't, what it means for your taxes, and then there's a lot of analysis. Okay, is it a smart thing to do now because you're paying more tax now in order to pay less later? A Roth is a fabulous thing. I mean, once you get into it, it's tax-free forever. And your heirs can inherit it. It's really a spectacular thing, but it makes sense for some people and not for others. And so, where's the first place someone might go? They go to the app, and they ask about Roth conversion. And it will not only tell you about the rules, but it will also then interpret it in your particular case as to what might make sense for you. That's number one. But to the extent that you're actually thinking about doing anything, we encourage you, yes, you've got this great contextual information, but in the same app, schedule an appointment with your advisor, because by the time you get to a consequential decision, you really want to be working with somebody like Matt. And in fact, every one of you wants to be working with someone like Matt.
Oh, I have a mic? I have a mic? Good, it's on, thank you. I have 4 questions for you. First one is, how many years has Evergreen been in business? You give me the impression it just started, but I see people all around wearing your company name on their jacket. So how long have you been in business with Evergreen?
We've been working on this for 18 months. And that's a long time to develop technology. And, if you're doing photo sharing on the web or something like that, you can whip that up pretty quickly, and particularly today with vibe coding and all that. But we're different because we're actually managing people's money. And we've got the security issues, and we're doing it on the banking side and the investment side at the same time. And we're trying to weave in AI that doesn't hallucinate and gets great contextual answers. And so, yes, it's taken us longer than many consumer software companies might take, but it's a big job. So 18 months.
3 more questions, okay. Next one, how many offices do you have and where are they?
We have 3 offices, one in Miami, one in Raleigh, North Carolina, and one in Dallas. However, I'm looking forward to putting one in New York, because in New York, and one in Palo Alto, because the people in New York and the people in Palo Alto and all through California, they need us.
Okay. How many employees do you have now?
About 50.
Okay. And what is your capitalization?
You mean how much are we worth?
How much have you put into the business?
I don't talk about that, but over $10 million.
Okay, let's take one more question. Over here.
Yeah. All right. What did you learn about building companies from your time at PayPal? And did you think you were working with someone who would become the richest person in the world?
Yes, I thought I was working with someone who would become the richest person in the world. I thought that was me.
Played.
So, what did I learn working at PayPal? It's actually more what I learned not to do. It was complete chaos. And quite frankly, some of the great things come out of environments of complete chaos. Just look at your successes. I was theoretically the CEO. I was 40 years old, so I was the adult supervision. It was not clear on any particular day who actually was in charge. Some days it was Peter, some days it was Elon, some days it was me, some days it was no one. And we would show up, and quite frankly, we almost came to blows some days, just because there was such intensity. But from that intensity, I think what I learned was not to be scared of uncertainty. And that's the biggest thing when you're going to start a company, and you know this very well. If you're going to join a startup, the traditional thing is say, well, it's risky. I'm taking financial risk. I've got a mortgage. It's career risk. But that's not the thing. The thing is being comfortable in ambiguity. Because you show up every morning and you have no bloody idea what you're supposed to do. You're making it up as you go along. There is no playbook. You just figure it out. And some people like that. Most people don't. most people like to wake up, know what time they're going to work, know what time they're coming back, and to have an idea what their specific goals are. And by the way, that makes all the sense in the world. But for those people, a startup is not the thing. So I learned two things. I learned not to be scared of uncertainty and chaos, and also from both, well, from all three, from Peter, from Elon, and from Max. I learned to some extent, not like them, but I learned to be bold. I learned to say, okay, my rational mind doesn't think that we can do this, but I think we can. And then sometimes it works and sometimes it doesn't, but you need that. I mean, Elon is the boldest business person I've ever met. There are a lot of things that I don't like about Elon, but in that sense, incredibly inspiring.
I think we can do it too. I think we can do it too here at Evergreen Wealth. Michael, thank you so much for your fantastic
Hey, Michael.
question.
All right. Hey, Bill.
And thank you
By
so
the
much
way,
to...
one
Oh,
thing for
please.
me, thank you for that, but for all the people working for Bill, there shouldn't be any uncertainty. You now know the man has a tremendous ego. Just go ahead and play to that ego. You'll be successful.
Noted, very helpful. Thank you. Thank you for that. But again, Michael, thank you. And thank you to everyone in the room and on the live stream for your fantastic questions today. And if you walk away from today with one thing, we just ask that you remember: earn more, keep more, build everlasting wealth for you and your families. That's Evergreen Wealth. Thanks for being part of our journey
All
today.
right. Thank you all.